Something a bit different. Today I want to speak about market structure in general, how you can identify market structure in the market, and how you can actually take advantage of market structure. This is not a trading strategy or anything like that. It's just basic technical analysis uh, as well. So in the market we've got two levels. The first level is called a level of it's called a level of resistance, and then we've got another level called a level of support. Now you can think of this as the ceiling in your house, and you can think of this as the floor in your house. This is the highest point that the market would go, and this is the lowest point that the market would go. Now once the ceiling gets broken, the ceiling would then become support, and you can expect the market to go higher. When the floor gets broken, the floor will become support. Once the floor gets broken, the floor will become the ceiling, and you can expect the market to continue higher. Now, there's high probabilities for the market to reject from that area, giving us nice selling opportunities from there as well. Now, there's also nice buying opportunities because we know that we have to buy low and we have to sell high. Excuse me. So this is basically what market structure means. Market structure is basically support and resistance in the market, and I'm going to explain to you how you can identify this and how you can utilize and make use of this in the market as well. Remember, the easiest way to understand this: resistance is the ceiling in your house, support is the floor in your house. So that's basically the lowest point. So we're gonna have a look at what we have over here on NZD/JPY. Now, one thing that you need to keep in mind, structure gets created when there's a red and a green candle printed next to each other. So once there's a red candle and a green candle, or a red candle, green candle, that is considered structure. As long the minute you see two different color candles are printed, you can consider that as structure in the market. Now, we can see over here what we have. We've got a red candle and we've got a green candle. We've got a red candle and we've got a green candle and a red candle. So what that basically tells us is that we've just identified a level of resistance floor, and then a level of resistance which is called the ceiling, and then we've got a level of support that is called the floor. So like I explained before, if the market breaks above that level, you can expect the market to continue higher. If the market breaks this level, you can expect the market to continue lower. Now what we need to do is we need to wait for a clear break on the daily time frame. And the reason why you want to look at this from a daily perspective, so you just look at the market because you want to understand market direction. The big banks, hedge funds, and institutions, they look at higher time frames, also monthly, weekly, and daily. They are the best time frames for direction in the market. So what we are going to do is we're going to wait for the market to break either through the floor or through the ceiling, and then we're going to go and then what you would want to do is basically just drop down on a lower time frame and then apply the same concept and look for selling and buying opportunities. And the best way to do that is to either sell or buy to a previous structural level in the market. That's it, because we know that price moves the market. So for this case, we're just going to go with the 4-hour time frame. But before we do that, we're first going to wait for the market to give us a clear break so that we can see where the market wants to go. Now you can see how the market tested the floor again, so we don't want to buy or sell. So we're just going to wait. You can see how the market went and hit the ceiling. Now the market come and hit the floor again, but we don't want to enter yet. So you can see how the market dejected. What you want to wait for is you want to wait for a clear break and the market to close below this floor level before you go on a lower time frame and look for potential selling opportunities or buying opportunities in the market. So that's exactly what the market did over there. So what you want to do from here is, now that you know the floor is now broken, so the floor now becomes the ceiling, so you can use this as an opportunity to look for potential sells in the market. So now that we've got a clear break below the structure, what we want to wait for is we need to wait for the market to come in, hit that level first and reject it. We want the market to break the floor, come and test the floor, if the floor will become the ceiling, and then you look for potential opportunities. So the market broke down. So now we can see how the market came and tested this floor level that is now the ceiling. So now that the market had done that, So what we want to do is, if we go on the 4-hour time frame, what you want to do is you now also want to wait for the market to create structure again. Now let's say, for instance, this would be also structure here in the market. So we're going to use this structural level, for instance, in the market. So we know that once the ceiling, once the floor gets broken, it's going to become the ceiling, and then we're going to look for a nice selling opportunity over there. So let's see what happens. So the market then broke through this floor. We know it becomes the ceiling. So what we're going to do is we are going to sell the market at that price, because we are going to follow the same principles that we did before. And what we're going to do is we want to buy the market back to previous structural levels. So we maybe going to use that as a take profit 1. We're going to use this as a take profit 2 level, and then we're also going to use this as a take profit 3 level, and then we're also going to go and go, because why, this was the ceiling once, it's now the floor. So we're going to scroll this all the way down to that level, and then what we want to do is we want to put our stop losses uh, above this previous highs, because we know how market structure works, because we know that this is currently a ceiling level in the market. So we know when the ceiling gets broken, the ceiling will then become the floor and we will get stopped out. But we know we would have been stopped out at a good pricing, at a good price point over there. So let's see what had happened over here. So there you can see the market started to go down and down, and then down again. So what we want to do is we can see how the market is continuing to create these levels of floor, of floor and ceilings in between. So we've got a ceiling there and we've got a floor. So the floor is going to break and it's going to become the ceiling, or the ceiling is going to break and it's going to become the floor. So let's see what happened. There you can see again, same principles. There we can see again, here we got another floor level over there. So let me just clear up this so you guys can see. There we got a nice floor level, and there we got a nice ceiling level there as well. So there we can see the floor is now, the ceiling is now acting as a level of floor, and let's see if it's going to hold. And then we broke below this level, the market then shot right through it, excuse me, and there you can see the market finally broke below that level, and you can see how the market basically wants to continue lower. And what I want to do is, and then we went all the way down. So now I just want to clear the charts, and I want to explain something for you guys here quickly. So I want to just go back here, and I want you to basically see how this concept had applied itself over and over and over again. So I'm just going to mark all these levels that we had here in the market, and when I go for all of the lows that we had over here, so we got that low, we're gonna go with this low over here, because we don't want to go use too much of them. So first thing that we had there, that was a floor level. That floor level then got broken. The market then came back, tested that floor level, that went down. We had a low floor level there as well, which the market then tested, but we obviously waited for the pullback on the daily time frame. Then we saw the market broke below this floor. That floor became the ceiling. The market then tested that ceiling level. The market then went down. The market created new flooring over there. The market broke below that, tested it a couple of times, then came back, and we can also use this here as well, because this was also acting as a floor level. Came back for the test, then the market did this consolidation, what they call consolidation. A floor was created here, floor was created there. The market broke through the floor, came back for the retest. Floor was created there, floor was created there as well. And you can see also how this floor got broken, and then the market continued lower. The market created a floor level over here. It broke through the floor. The floor became the ceiling, and the market continued lower. So that's one way down. So and then what you can basically do is you can use the same principles over here as well. So here we got a level of ceiling, and here we got a floor level. So basically you can apply the same principles that we've just applied over here. You can apply it there. Um, And that's where the concept comes from: buy high and, well, buy low and sell high. Now that's all for today's video, guys. If you're new here, please don't forget to leave a like, subscribe. I will be dropping more content throughout the course of the week. Also, if there's anything that you want me to cover, any page you want me to cover for you, just drop it down in the comments below. Once again, thank you so much for your time and the support. I really appreciate it. Thank you. Cheers for years.